Online used car retailer Carvana appears to have almost completely recovered from its near bankruptcy and is making waves in the financial markets as it's announced that it is profitable for the first time in the company's history. Carvana stock surges on first annual profit, pair of analyst upgrades. And pair of analyst upgrades just means that analysts have upgraded the stock. So stocks have three grades. I believe it's buy, hold, and sell, where if a stock is going to go up according to the analysts, then they recommend that you buy it. If they're not sure, they'll say hold it. And if they think it's going to go down, then they recommend you sell. And so analysts have upgraded it from either a sell to a hold or from a hold to a buy. And as you can see from their stock price, the article is actually quite accurate. In just this year alone, Carvana stocks are up basically 90%. Now, the most astute of you will note that even though they're up maybe 90% this year, they're still a far cry from their absolute peak in 2020 and have quite a ways to go in order to get back the share price they had in the mid 300s. Now, I want to go over the reasons this specific jump happened this year, and it's for two big categories of reasons. The first is the CEO making a lot of shrewd business decisions that actively benefited the company and helped it turn its entire trajectory around. And the second category of reasons is kind of just dumb luck that the CEO, of course, will not give any credit to, because it doesn't look good for a CEO to say that he just kind of happened to hit gold at the right time and that helped turn his company around. But we're going to be looking at both of those reasons. But the very first thing we have to look at is what Carvana actually is. And as you can see here, you get the car without the car salesman. It's 100% online, and you can pick up your car or have it delivered. So it's basically just online shopping for cars. You look online, you see what you want, you buy a car, and then you either have it delivered to you, which I assume has some kind of a delivery fee, or you have it delivered to a Carvana location, and you can go pick it up. And a lot of major cities have these. You'll see them on the side of the highway. It's the big tower of cars that says Carvana on it. If you've purchased one, you go there and you pick it up. Now, Carvana started in 2012, and in 2017, it went public to a share price of $11.10. And as you can see over the next little while, it actually grew fairly well, jumping 900% essentially over the next 3 years until the pandemic hit, and its stocks initially dropped because everyone's stocks initially dropped, and then it absolutely exploded throughout essentially what was the rest of the pandemic. And this was because the pandemic meant that the supply chain was bad enough to where cars weren't being manufactured, and also COVID meant that there wasn't a lot of contact allowed when doing things like selling cars. And this perfectly positioned Carvana specifically to sell used cars because they had already been manufactured online because there was no contact that way. It was the perfect storm of reasons for Carvana stock to take off as everyone started to view this as the future way cars were sold. Now, this caused the stock price to get crazy inflated as a ton of people started buying into the stock thinking that this was the new way people would shop for used cars with no contact because, of course, the pandemic was going to be around for a while, so this kind of was the future as far as people could see, except Carvana failed to really make any kind of a profit. And as you can see here, the amount that they were losing per year continued to grow and grow until a little bit in 21 and a huge amount in 2022, but that was a completely different reason. We're absolutely going to talk about what happened there. And between continuing to lose money despite tons of investments during the pandemic and also the fact that the pandemic was ending, so supply chains were getting back to normal, people started to pull out of Carvana because if they hadn't been profitable during the absolute best time for an online used car retailer to exist, how were they going to be profitable afterwards? And as people started to sell off their stock and pull out of their investments in Carvana, things progressively got worse. Carvana stock collapses amid bankruptcy fears after creditors packed and another $1 price target. And this was in December of 2022. So basically, Carvana had failed to capitalize properly on the amount of money and popularity they got during the pandemic. And so now that it's over, people are starting to pull out. Carvana's not getting as many investments as it had before. Other companies like Auto Trader or CarMax are starting to catch up, and Carvana probably has billions upon billions of dollars in debts and interest payments that it still has to make, but it's not able to because it's losing so much money. Now, amid these bankruptcy fears and a worry that the company would be liquidated in order to pay creditors, the CEO made two very significant business decisions. The first one, you probably guessed, was layoffs. Used car retailer Carvana lays off 12% of its workforce. Carvana company would lay off about 12,500 employees, or 12% of its workforce, the company said on Tuesday, as the online used car retailer works to gain back profitability weeks after its reported dismal results. And while I'm usually critical of layoffs because often companies that are already very very profitable do it in order to try and boost their stock price a little bit in the short term. In this instance, I think it probably was the right call. The company was most likely going to be dissolved in order to pay off creditors if it filed for bankruptcy, and so it's understandable that instead of 100% of the employees being laid off, only 12% were laid off. It came down to everyone losing their jobs or just a small percentage of people losing their jobs, and Carvana went with the small percentage of people losing their jobs. The second significant thing Carvana did was they restructured their debt and renegotiated with the people that they owed money to. Carvana announces agreement with note holders, that's people who hold notes to their debt, that will provide the company significant flexibility as it continues to execute its profitability and growth plan by reducing total debt, extending maturities, and lowering near-term cash interest expense. Now, this whole section is long and complicated with a lot of financial mumbo jumbo that you don't need to read, but feel free to if you would like. But basically what happened here is that Carvana managed to renegotiate both the amount of debt they had and also the interest payments on that debt and get both significantly lowered. Now, as for how the company got their debts reduced, I don't actually know, but I would speculate that the CEO probably took some kind of an asset report over to the people that he owed money to, and he said if you were to liquidate the entire company in order to try and pay off the debts, it would only pay off maybe 5% of the entire debt, maybe up to 10%. I don't know. Those are just speculative numbers. And then he probably also showed them a path to profitability that he would realistically be able to hit if they were to reduce the amount of debt that he owed them. I'm making up numbers for an example, but say the CEO said Carvana has $100 million in assets, but we owe you $5 billion in debt. You can take the assets away from us to pay off the debt and you'll make $100 million, or you can reduce the amount of debt and interest we actually owe, and over the next 10 years or 20 years, you will make far more than $100 million because we'll be profitable and actually able to pay off the debts. And the creditors probably looked at the amount of money that Carvana was making, how much it had in assets, and how much it could make if they reduced the interest on the debts, and probably said that it seems like a good business plan, and they were willing to reduce the debt and the interest on the debt in order to let Carvana become profitable and be able to pay more money in the future in interest payments than they would actually be able to get if they liquidated the company into bankruptcy. This was a very smart move by the CEO, and it worked out really, really well, and literally the same day that this was announced, Carvana stock spiked 40% after company announces debt exchange deal quarterly results. And this is because people are realizing for the first time that Carvana maybe actually has a chance. They reduced their debt by something like $430 million in interest payments, which is absolutely the difference between becoming profitable and being a long-term sustainable company, and just going under completely and being liquidated and sold off in order to try and pay off your debtors. So between the layoffs to save money on labor costs and also the renegotiation of the debt in order to save money on interest payments, that set up Carvana perfectly to be right here where we are today with $150 million of income for the first time in the company's history. And this note right here, this negative $2.9 billion in loss, that's after they renegotiated the amount of debt they have. They put a ton of their assets into paying off debt so they would not have to pay those interest payments in the future. So they basically went for broke in 2022, knowing they were going to lose an absolutely tremendous amount of money, but also knowing that with their reduced debt, reduced interest payments, if they paid a ton of it down now, they wouldn't have to make more interest payments in the future, and that additionally set them up to be profitable again for the first time ever in 2023. They were probably aware that it would negatively affect their stock price in 2022, but they were hoping that they would more than make up for that in 2023 by becoming profitable. And we essentially see that happening with future projections in 2024 continuing to go up, and maybe they'll reach where they were in 2021 at their absolute peak during the pandemic. Now, I said there were two categories of things that helped Carvana get profitable. One was the CEO's decisions, which we just went over with the layoffs and the debt restructuring, and the other was basically just dumb luck. And out of curiosity, I looked in their shareholders letter to see if they mentioned the dumb luck aspect of it that I'm about to tell you about. And let me tell you, first of all, 29 pages of just riveting stuff, real page turner here. It's actually one of the most boring shareholder letters I've actually ever read. Netflix's, which I also sometimes read, are far more interesting, but he basically attributes the entire thing to the fact that they're no longer paying as much as they were on debt. By year end, we had also removed over $1.1 billion of annualized SG&A, which is selling, general, and administrative expenses from the business since our peak in early 2022, driven primarily by our focus on efficiency and also the fact that they had paid off a ton of debt. But it does make sense that the CEO wouldn't want to tell the shareholders that while he also made some good decisions, he also just kind of happened to hit the lottery lucky lucky, and that helped turn the company around. But in general, the reason I believe that Carvana is doing well, in part, is because it's just kind of been a good couple of years for used car companies. If we look at Carvana's stock, which has jumped a little bit since 2023, and we compare it to other similar car companies, which Auto Trader, you can see it's also jumped a little bit, around 30 to 40%. There's another one, CarMax, which has been rough recently, but it's also actually jumped about 30% over the December 23 to March 24, so that's had some increases as well. So a lot of the big used car market players are all doing well. It's just kind of the market conditions are shaping up such that used car companies in general are on the rise, and Carvana is kind of a ship that's being lifted with all the other ships as the harbor fills up. And I think used car companies are doing so well for one main reason, and I'm absolutely down to be wrong, so please let me know in the comments if you think there's some other reasons, but I think it's because of interest rates. See, this is the interest rate on a 60-month new car loan in the United States from February to November 2023. Look what it's done recently. The interest rates have absolutely skyrocketed on new cars. And not only has it skyrocketed on new cars, it's also gone up significantly on used cars as well. Since 2021, you can see it's gone up pretty significantly, from about 13% to a little over 16%, with a slight dip down to 15%, but probably we'll see that increase back to 16% as well. It's just a really good time to be giving out car loans. And guess who gives out car loans? That's right, anybody that sells cars, including Carvana. Edmunds even writes reports on this kinds of thing. This is from October of 2023, so just a few months ago. It says, new vehicle monthly payments to climb to new heights in Q3, according to Edmunds. Analysts say swollen interest rates are the culprit behind record financing figures in both the new and used markets, referring to car markets. So as interest rates on car loans go up, the companies that issue those car loans, which is Auto Trader, CarMax, or also Carvana, also goes up. They're making more money. And if they're making more money because interest rates are going up, then they're more likely to be profitable. So did the CEO make good decisions for the business that helped things turn around? Absolutely. Did he also happen to just completely luck out on the fact that interest rates are going up and up and up, and consumers seem ever willing to spend that amount of money and make Carvana just oogles of money on the back end in those interest payment collections? Absolutely. Thanks for watching.